Navigating the complexities of asset transfers from special economic zones (SEZs) under GST regulations requires a meticulous understanding of the rules that govern these transactions. The value ascribed to asset transfers, particularly between related parties, follows specific guidelines laid out in Rule 28 of the GST rules. This rule stipulates that when determining the value of a good or service, adhering to the predefined criteria is essential for compliance with GST regulations. For old or used assets, the valuation process becomes a bit more intricate. Should the value of like goods remain indeterminable under Rule 28, one must turn to either Rule 30 or Rule 31 for guidance. Notably, as the cost method proves unsuitable for evaluating an old asset, it becomes imperative to consider the residual value post-depreciation as the basis for cost assessment. Since both Rule 28 and Rule 30 do not cater effectively to used asset transfers, reliance on Rule 31 is crucial. This rule demands a determination of value through reasonable means, while also adhering to Rule 49 of the SEZ regulations. When transferring an old asset from an SEZ to the domestic tariff area, DTA, one must comply with the SEZ regulations, particularly as defined in Rule 49. As per this guideline, the duty applicable on capital goods being removed follows specific criteria. Primarily, the duty is levied on the depreciated value of the goods at the prevailing rate on the day of their removal. The period of depreciation is calculated from the commencement date of production, or the date the asset was first used for production, until the bill of entry presentation date for home consumption. The straight line method is employed for calculating depreciation, which varies based on the type of asset. Computers and peripherals have different depreciation rates than capital goods, which emphasizes the necessity of thoroughly understanding these prescriptions to ensure accurate valuation. In conclusion, it is vital to establish an assessable value for asset transfer based on the SEZ Act, particularly when transitioning assets to DTA or other SEZs. By following the guidelines outlined in Rule 49C, businesses can effectively determine the transfer value for GST compliance. This careful calibration of value ensures adherence to both GST and SEZ regulations, ultimately streamlining the asset transfer process while fulfilling the requisite legal obligations.